Hey everybody, welcome to this free edition of our Traders Weekly Roundup for the trading week ending May 31st, 2024. I'm Preston Brent. Thanks for tuning in. Well, as you can see, the theme for this week is "Are bulls getting tired?" More on that in just a minute when we get into the charts. But why don't we take a look at how we fared this past week? And you can see here when we look around the world, and starting with the U.S. first in this holiday shortened week, the markets we're all down in the red. Okay, year to date, solid in the green, double digits with S&P and Nasdaq. Everybody else just barely in the green. But this week we saw small caps performing much better than large cap. Value stocks held up better than growth shares. And this past Friday, rounding out the month of May before close, about 30 minutes before close, we saw a mad dash to value and risk off equities. I'll show you that in a chart in a minute. And you can see the PE ratio, the trailing is 23.07, but the forward 12 months is 21.45. So it's lower by about 7%. Dividend yields coming in at 1.38. 10-year Treasury closed out the week at 4.5%, which is about 312 bips higher than the dividend yield. Okay. You can see the VIX was actually up for the week, not by much, but up a little over 7% to close out the week at 12.92. And if you look at the sector performance for the week and for the year, the best sector for the week was energy, worst technology. For the year, we're still showing very strong growth in utilities. For our members, Sunday evening for our weekly market watch, I'll go through some opportunities in the utility market and why they're so strong this year. Real estate bringing up the rear, 4.4% underwater. This week, we did see PCE come out. And if we look at core PCE, which is less food and energy, and this is kind of considered the Fed's preferred inflation gauge, it rose 20 bips in April. It was down slightly from the previous 2 months, but still a lot higher from where it should be. If we're shooting for the Fed's 2% inflation target. Supercore inflation, which is the PCE services excluding energy and housing, and that's becoming more and more a focus of attention here, kind of offered a mixed picture. It rose about 30 bips for the month, down a tick from March, but up from February. All right. And we did see Case-Shiller, the index of housing prices in major U.S. markets, rose 7.4% over the past 12 months. All right, that's the highest level we've seen since October 2022. And then the other thing we had a little bit of a bip this week was the Treasury Department. They had some midweek auctions in 5- and 7-year Treasury notes. And they were met with really subdued demand, which meant that weak sales raised a little bit of concerns of funding the continuing and growing, I might add, U.S. deficit. Okay. So it's going to be real interesting to see, it's going to drive up yields or keep yields higher for longer. Meanwhile, also upsetting the apple cart this week was Fed Governor Neil Kashkari. He came out contributing to some of the sell-off on Tuesday by saying, I don't think anybody has totally taken rate increases off the table. He did say that the odds of us raising rates are very low, but we, don't want to take anything off the table. So that also upset the markets midweek in this holiday shortened trading week here in the U.S. coming off our Memorial Day weekend. Okay. So all in all, the markets, although they're up higher through the first 5 months of the year, over 10%, as you can see, NASDAQ up over 11%. And statistically, and odds suggest the remaining half of this year is going to be met by a strong growth as well. But we got to be very, very careful. And I think the markets are going to be a lot more choppy and volatile in the second half of the year than the first half of the year. Okay. Now, if we come over and look at Europe, you can see over there, everybody was in the red also for the week. This is a week of consolidation and slight pullback. Year to date, Euro stocks, FTSE, CAC 40, DAX, all up year to date, right? But for the week, it was just more of a consolidation, slight pullback. And we did see headline inflation in Europe rising for the first time in 5 months. Consumer prices ticked up 2.6% in May. That was 2.4 from the prior month. All right. Services inflation also in Europe accelerated to 4.1 in April from 3.7. Um, or in April 3.7, May it was 4.1. So we're getting this rise slightly in inflation across Europe. Meanwhile, a measure of core inflation that excludes energy and food, alcohol, tobacco over in Europe, it also increased to 2.9 from 2.7. We did see unemployment fall to a record low in Europe of 6.4%. It was 6.5% the prior month. But even with rising inflation for the first time in 5 months, one of the ECB chief economists came out signaling that they're going to probably lower their rates by 25 bips on June 6th. That would be next week, actually, or the week coming up very quickly, right? So I think next Wednesday or Thursday. So we're going to see how that plays itself out. Meanwhile, if we go across to the Asian markets, you can see everybody was in the red there too. Nikkei, China, Hang Seng, all in the red. Year to date, still in the green. Japan, the focus is still on the prospect of the Bank of Japan ending or slowing down their monetary policy. They're looking to normalize their monetary policy. Meanwhile, the yield on their 10-year Japanese government bond rose up now over 1%. Remember, I started talking about it when it was around 65 bips. Now it's over 1.07%. Okay. Prior week, I think it ended right at 1%. So the markets are still making the bet that they're going to normalize their policy. It's going to strengthen the yen against the dollar. I've been saying for a while now, especially to our members, that being long the yen dollar is going to be a nice trade over the remaining part of this year going into 25. Okay. Meanwhile, in Japan, they did see their core CPI accelerated in May to 1.9%, but it's still below the BOJ target of 2%. And if we look at China, you can see they were in the red for the week, just barely. Year to date, they're in the green. Hang Seng in the red a little bit more, which is the Hong Kong index. But we saw their PMI fall into contraction territory to 49.5, right? In April's at 50.4. So just barely hanging in there above and below contraction. Okay. But that was their first official monthly contraction report since February of this year. Okay. Um, And we're also seeing their PMI sub-indexes within that for new orders and exports are also declining as well. The non-PMI, which would be their services, slipped a weaker than expected down to 51.1. All right. So everything is slowing down over in China as well. And earlier in the week, the International Monetary Fund, the IMF, upgraded their 2024 economic growth forecast for China to come in at 5%. Their prior forecast was 4.6. I'm not really sure. Most of the data that comes out of the official numbers from China, I'm not really a big believer in anyway. I don't trust a lot of their numbers, but still, they are in a contraction territory. They're still trying to shore up their real estate market, and that's creating a lot of drag on the Chinese markets, even to this day. I think it's going to go through the rest of this year and early next year. What I want to do is I want to switch over. Let's just go back to the US again. Let's take a look at the US charts. We'll take a look first. Well, let's take a look at the SPX. Let me just switch over there. So bear with me 1 minute. I'm going to bounce around the screens here. We're going to look at the SPX. It'll take another 10 seconds to come up on your screen as I refresh my charts. And the SPX is the cash index, obviously. And what I want to show you here is, and this is the target that I had for the SPX. I had this up here well back over in early April when we were moving lower. I established a target here that was a combination of Gann and Fibonacci extensions off prior pivot highs and lows. And I said we're going to run up here a midpoint of around 53.30. And we ran right up. Intraday, we hit 53.4188. You could see this colored bar represents my resistance point. And there's a 38% fib extension of prior pivot highs and lows. And then we sat there for over a couple of weeks. This is a daily chart. We pull back. I said the next support point would be the 50 EMA outside of 52.26. You can see we got very close to it. And then we had, this is almost like a hammer candle, which suggests more upside, which could run us back into a R1 level right up here around this same level. Do I think we're going to get through it in the month of June into July? Well, it all depends. Keep in mind, we got the Fed's meeting. We got key CPI data coming out. And then we got the Fed meeting here, not next week, but the week after. And the CPI data is coming out the day before the Feds meet. And that is going to be the first time we get, remember, every quarter end, we get the Fed dot plot. Their last dot plot showed 3 rate cuts for the year. Now the markets are saying we should get higher probability of 1 rate cut. Remember, in January of this year, we were looking at 5 to 6 rate cuts. Then we moved it down to 3 rate cuts. Now we're down to 1, maybe 2, but probably 1. And in Barron's weekend edition, this weekend, Barron's is saying that the Feds won't cut at all. So, needless to say, the rate cut probability has gone down. And you would think it would put downside drag or upside drag on the markets, forcing the markets lower. But so far, we've had strong consumer spending and strong earnings. And then the question is that going to continue? Well, just understand that um, the earnings season is now over, so we got a quiet time, and all we got to listen to is the Feds with their new dot plot, the new CPI data coming in. We got PCE this past week, and as I said, it came in right at expectations, although the services side and rent drove it up just a little bit. So I just don't see if I had to forecast this, and I hate forecasting what the Feds are going to do because it does enter into a little bit of the political realm. And although they say they're not political, they can't help themselves. I do believe they'll probably do 1 Fed rate cut, but I don't think the economy can do that. I think there should be 0 rate cuts. But this is kind of what we're looking at here. So I do see potential momentum carrying us up after Friday's close, but I don't think we're going to get much over this area right here, and then we're going to run into trouble again. Okay. We may get a slight pullback if the Feds surprise the markets and say 1 rate cut, and then they enter in there and interject that a rate hike, they don't want to take it off the table. That'll give us a down day or a few days for the markets, just like we got with Neil Kashkari when he came out with that comment this past Tuesday, and the market sold off more. So this is kind of what I'm looking at right here. Now, if I were to do a longer term projection, I would say we're going to, if you look at statistics, they would say that the markets, anytime through the first 5 months of the year, you're up over 10%. The statistics suggest that we're going to go up another 8 to 12% in the remaining 7 months of the year. All right. That's what statistics would say going back 50 years. Although I think this time it's going to be slightly different. Remember, the markets, history sometimes repeats, but not exactly. And I think it depends on what the Feds are going to do, and depends on if consumers still spend. I am seeing some cracks in the AI armor in some of the earnings results. AI companies that miss earnings fall on average over 5.5%. Non-AI related companies that fail on earnings fall 2.5%. So there is a big gotcha for AI related companies, right? And we're seeing it now in some of the cloud based companies and Dell and a few others. When they miss, boy, it really moves the markets lower. So right now the markets are highly correlated to a lot of the AI. Remember, NVIDIA is over 6% of the SPX value, just NVIDIA alone. And if they miss an earnings, or they come in and report lower, then you're going to see a very ugly day for all of the AI stocks, SPX and NVIDIA. So you got to be very careful here. What I'm going to do is I'm going to shift the screen, and let's go over and look at the E-mini S&P 500 futures. So let me just get that off, and let's get over here like this. And we'll take a look here. And just it'll take a few seconds to come up on the screen. And like the SPX, it didn't quite get up to my resistance level here of around 5,400. But if you can see here, we did on the futures hit the 50 EMA. We came down and hit it nicely, gave us a candle pattern that would suggest we're going to come up and challenge these all-time highs that were made on May 16th. And possibly run up here and hit this level around 5,400. And then we're going to run into more resistance, and it's going to rest a bit. Okay. So that's kind of what I'm looking at. I do see momentum carrying us up into the Fed meeting, but the Feds can move the markets any which way. So we just have to watch that very closely. Now, if we come in here and just look at the equal weight SPX, The equal weight, you could see here on Thursday and Friday had a very strong day, but let me put it back on the 3-minute chart of equal weight and look at the money that came into equal weight stocks. It just took off. I mean, just straight through the roof, really starting around 3:40 in the afternoon with the markets closing at 4. The last 20 minutes of the day, these are 3-minute bars, the equal weight took off. I mean, just money really came into these risk off type sectors. Let's look at cyclicals, which happens to be a risk on sector. If you look at cyclicals, right? Look at what they did in the last 3 minutes of the day. Now, this is a custom index that I have energy, financials, materials, and industrials as it relates to the SPY, right? So it's an index weighted index that I put together of just cyclicals. And you can see here tremendous underperformance. And cyclicals tend to be very strong bullish when the markets want to be bullish. So this is a risk off move as well. Okay. And then, of course, if we come in here and we look at NASDAQ, okay, you can see NASDAQ as we went into close. We did have a strong rush into NASDAQ. But if we look at the FANGs, right, and I got a FANG index on here as well, right? The FANGs also, money came into these guys. So in the last 30 minutes of the day, I mean, it just, and here with the FANGs, it was right around the same time, 3:40, a lot of money came into the markets. It was amazing what flew in there. Okay. So that just goes to show that we had a lot of movement, sector rotation into risk off. And then if we look at the Dow, I mean, the Dow, it was amazing. Take a look at the Dow. The Dow tends to have been a risk off sector right now. Or an index, and look at it. Starting again at 3:40 in the afternoon, the Dow literally went from 38,500 to close at 38,800. We added over 300 points in the Dow in the last 20 minutes of trading. That was just a huge sector rotation at the end of the day on Friday, at the end of the month. Now, we could see some of this peel back. Usually it'll give back about 50% of the gains and then consolidate before moving higher. But it's just, I found that very fascinating how the markets move like that, right, in the last 20 minutes of the day. So let me come back to the daily chart here. And if we come down here and look at volatility and the VIX right here, you can see the VIX closed at let me just go over here like this. All right. So the VIX closed at 1292, but you could see here it moved up, but we're still in the green. And if we look at the front and back ratios, the front month skew and the back month skew, if we look at the front month skew, which is the VIX compared to the June futures, we should be well in the green. And we're not. We're just right here. And vol is going to stay bid until we get through the CPI and the Feds coming up in a couple of weeks. So vol can go up or down a pretty good deal either way over the next week and a half or two. So just be wary of what the Feds are going to do coming up, I think on June 11th, right? And we get the CPI on the 11th or 12th too, right around the same time. So that's going to be a very volatile, interesting few days. Okay. And if we look at the back month skew, it's going to be a little bit deeper in the green, but not that much, right? I mean, here we are down here, and which tells me that we've got a normal contango, not a backwardation, but a contango. And then if we look at the 2-8 spread comparing July and December volatility futures, we're a lot deeper in the green. So this would suggest statistics are bearing out that we should have, another 8 to 12% run in the second half of this year. I'm suggesting that I don't think we'll see it. My target for the end of the year is anywhere from 53 to 5,500, which gives us about a 5% boost from where we are right now. But it's going to be very choppy getting there. And if we look at treasuries are going to be really moving big time over the next couple of weeks. And you could see here, they're still from the 23 close, it's making lower highs and lower lows. And that would suggest right now rates can stay elevated for a lot longer. Okay. And if we look at currencies, well, the dollar has been unusually strong this year. Remember, we're still hovering well above in the green, solidly in the green camp. We just took out the 50 EMA. And if we look at the euro, right, I want to get long the euro. I think the second half of the year, Europe's going to outperform the US. And we're going to consolidate here for a while, but I do believe the euro, being long euro over the dollar, is going to be a nice trade. And of course, if we look at my favorite, the yen, I like the yen to the upside longer term, right? And you got to have a long term view on this thing. And even though it's down at these levels down here, I do love it to the upside, right? Long term, not next 30 days. And if we come down here and we look at gold, I think gold's going to give it up a little bit here. So you want to be a buyer on the dip. It came up not quite hitting my target. My target was right around 2,500. We moved up to 2454. It's going to hover around here. I think it's going to break the 50 EMA and come down to this gap right here, fill that gap around 2250. All right, we're at 2347. So another 100 points to the downside. And then I'd be more interested in buying. Okay, you could see that tremendous bearish divergence here, right here with this. Just that was just a classic tell to short gold. Okay, and of course, if we look at silver, it's even stronger than gold. You can see it's hovering. That was my original target for silver. It moved right through it, and then my targets tend to be a sticky point. You can see there is no divergence here in this one. That second peak was an easy target to short. But I would wait for gold, silver and gold to pull back before looking at entering any longs. And of course, if we look at the energy market and we look at oil, I think oil is just going to drift a little bit lower, not too much, but a little bit lower here. And then I'd be interested in going long oil. And then, of course, if we look at nat gas, I'm always, and guys, right down here, if you guys remember back over in March and April, I said, you got to go long nat gas. And here it goes. We had some members take this trade as a great trade for them. You're in the futures market, and that's $10,000, $15,000 in profit on just a contract. So really good trade right here. If it holds up, it's a little bit more dicey right here. Now, Elliott wave count would suggest you want to be a buyer of dips down here. Okay. But I like a little bit more of a surer trade, which was down in this area down here. But right here, I think nat gas is going to run higher, but it's the probability of that is like maybe 55, 60% higher. Down here, you had a 70%, 80% shot of nat gas moving higher. So the trade was to take is much better down here. We're not down there right now. So here, I still like buying the dips in nat gas. You can play it in the option market, and there are a couple of different ways to play. Our members understand some really interesting ways to play it. But for those of you that are non-members, I highly encourage you to come in and take a look at some of the stuff we're doing because it puts money in your account, which is what we're all about. If you come down here and ag, meat, softs, there's really not a lot right there right now that I'm interested in. So anyway, net, I do see the end of the year anywhere from 53 to 5,500. I think it's going to be very choppy over the next 2 weeks. We may have a continuation of the momentum from Friday, but it's going to be really tough getting through the Feds and it's going to be all up to what the Feds do with their dot plot. How they answer the question and what they're doing with the rates. That's going to be key. I think the dot plot's going to go from 3 to 2, maybe 1.5. The futures market will probably discount it to 1.5 is what they'll do. But anyway, at least there will be one rate cut. Inflation does not seem to be going higher here in the U.S. It's either holding steady or going lower. So the markets have pretty much made up their mind that we're not going to see inflation going higher. We're not going to see the possibility of a rate hike, although you get a Fed governor or two that say we don't want to take it off the table, but they're just doing their job. So right now the bet is inflation is steady to going lower. We're going to get 1, possibly 2 rate cuts this year. It's going to be even more rate cuts next year. Consumers are still spending. Earnings look strong, so that's going to keep giving the markets a bullish boost. Unless any of those narratives change, we should hit my targets by the end of this year, but there will be volatility thrown in there. All right, so we're kind of a buy the dip kind of thing. All right, everybody, that's where we're sitting right now. Members, I'll see you Sunday evening for our weekly market watch. Otherwise, have a great weekend, everybody. Ciao.